Financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Greetings, friends. Welcome to this week's broadcast. So glad that you're joining us all around the world. My name is Jerry Robinson, your host, your guide, leading you on an excursion to truth, financial truth. 2014 Financial Freedom Bootcamp. This is going to be your year to break free financially. And over the last couple of podcast episodes, we've been spending a lot of time going through our 5 levels of financial freedom. This week is no different. We're moving into level 3. We've already completed the first 2 levels. Remember, level 1 was all about creating that emergency reserve. And if you did not hear part 1, you're not too late. Just simply go back into the archives. You'll see it there. It's completely free. And then we moved on to level 2 last week. Level 2 was all about constructing your moat for your financial castle. Remember, we talked about creating that moat around your castle to provide you with protection against life, the things that we cannot control. Remember what we said about insurance, that dreaded word insurance. Nobody likes to talk about insurance. But insurance is an absolutely important tool that you can use and leverage for your own purposes. But I know many of you are probably wondering, when are we going to get to the good stuff? When are we going to get to the things like investing in stocks and investing in real estate, or maybe trading stocks, or maybe investing in gold? Well, today we're going to move into part of that. We're going to talk about diversifying our liquid savings into 3 asset classes that include gold and silver. So we'll be talking about that a little bit today. So let's just dive right in, shall we? Let's move right into level 3 this week. We're going to talk about the 3 areas, the 3 steps to level 3. All right, we've already went through level 1. We've already went through level 2. Now we're going to move into level 3. And the very first step of level 3 is to build a total of 6 months of food and water supply. Remember what we did in level 1 was we created 90 days or 3 months of food and water supply. Well, in level 3, before we move on to the investing and before we move on to all the fun stuff that we're going to be talking about next week and the week after, this week we're going to talk about upping the ante. We're really going to create that final financial buffer that's going to protect us as we move into the investing world. And the very first thing we're going to do in level 3 is to take our 3-month food and water supply and we're going to boost it to a 6-month food and water supply. Now, Jennifer, you and I have been doing this for some time. We have, we've had this 6-month food and water supply for quite some time, and we do it differently than other people do. Many people like to purchase these MREs, or they buy, lots of freeze-dried foods or things like that. Why don't you share with the folks how we have approached this differently?
Yeah, so typically people think when you have a long-term food and water supply, that you have these rooms and rooms in your house or maybe a storage building outside just full of canned goods, canned corn and canned meat and canned soups, and it's just full of canned goods, and you're probably going to have to toss half of them out because you're never going to use them. That is what a lot of people think about when they think about this long-term food storage.
Yeah, and it's not very appetizing. It's not like food you go, yum, that looks like I want to eat it. It looks like the stuff you would say, I'd only eat that in an emergency.
Exactly, but we approach this differently. The way Jerry and I do this is we simply purchase extra of what we already like and what we already eat each time we go to the grocery store. We do this on an ongoing basis. In the beginning, we had to do it quite a bit. We had to buy a lot of extra so that we could really build up to the 6 months. But now we just simply rotate the things that we like, and we actually eat what is in our 6-month food supply.
Yeah, there's so many foods today that stay good for at least 6 months. And so you find a bunch of those kind of foods that you like, and then you just eat them, and you put them in a rotation to where you're not having to store away all this food that you're never going to possibly eat unless the apocalypse. That's not really what this is all about. You know, a perfect example has been all this wicked weather. People can't get out to the store up in the Northeast, or even down here. You know, I was reading this week that even down in Houston, Texas, where we both lived for some time, you know, they're battling with some crazy weather. This has been some wicked weather, and this is a perfect example of what we're talking about, that having this food and water supply stored in your home or somewhere nearby your home really empowers you. It protects you from some sort of major crisis.
That's right. And remember, just a couple of weeks ago, some towns in West Virginia had the major chemical spill, and they couldn't drink their tap water. People
were going to the store in West Virginia buying bags of ice and then melting the ice down just to have water because they didn't have water.
Right. We don't think about running out of water because it just seems so plentiful. You just turn on the spigot and there it is. But this is very important because you never know what can happen. And people might ask, why is this part of your financial plan? Well, it's very simple. Number one, what good is having a big financial castle, so to speak, as Jerry called it earlier, if some disaster happens and you can't even eat and you can't even drink water?
That's one of the cases people say about gold. They say, well, I can't eat it, you know, and if there's a case of disaster, then, you know, my gold's no good. Well, that's not necessarily true, because gold is never going to lose its value overall. It never has over the last 6,000 years of humankind. However, they do have a point in the fact that if you don't have something to eat, that gold won't do you any good. I mean, of course, you can trade it for food, but what if you can't get out of your house, you know, for some reason or some emergency or some weather event or something?
Exactly. And then the second reason why this is important is, let's say there is some chaotic situation in your city or in your area. Well, food is actually a very good bartering tool. I mean, last time I checked, everybody needs it. And so if you have food, you can barter for other things that you might need, maybe medical supplies or shelter, you know, what have you, in the case of a major catastrophe. But then also, of course, you can anonymously help your neighbors and your friends in a time of need. Now, one thing to remember is that you probably don't, let me rephrase, you probably want to be careful with whom you openly share your notion of keeping 6 months food and water. Because like a family member, an older family member once said to Jerry and I, there is nothing scarier in this world than a man who is hungry and whose family is hungry.
The last thing you want to see is a man who is hungry walking down towards your house. People who are hungry will do crazy things. Now, why are we talking about this? You're saying, I'm sure you're listening, some of you are saying, why are we talking about this on the 5 levels of financial freedom? Well, Jennifer's already talked about it. The fact is, these are very uncertain times, okay? And you know that, and I know that. I mean, we're looking around the world today seeing all of this chaos, all of this disaster, not just weather-related, but also geopolitical tensions. We're seeing, you know, wars of words between many different nations. It's a difficult time. And it's important, I believe, imperative, I would even say, to be prepared for that. And we're not talking about, you know, having garage full of Y2K kind of food or anything like that. We're talking about very basic things. And that is, as we've already said, figure out what you already eat and then buy extra. Every time you go to the store, buy an extra can. The practice that we take is that when we go to the store, if we're going to buy one of something, we say, why are we just buying one? If it's going to be good for 4 or 5 months, or maybe even longer, maybe even a year, why not just buy 5 of them while we're here? And so we get into the practice of always buying a little extra every time we go. That way, in the event that we, A, don't have time to go to the store that particular week, or B, you know, let's say there's a weather event, we are stocked up. We're not desperate to get down to the store.
That's right. And for those who are really progressing through these 5 levels of financial freedom, and you are trying to continue saving and building up your savings reserve, because as we're going to talk about in a moment, we're still building up that savings reserve, well, you probably don't have a whole lot of extra to spend on a lot of extra groceries every week. So the last thing you want is to have your food that you buy go bad, to waste anything. And so that's why we say buy what you already like to eat. And of course, rotate through your water supply as well, because there is no sense in letting any water go bad either. Those things do have expiration dates, and water can actually go bad if you don't have a plan and a system of rotation in place.
Yeah, we've done some videos on this as well, so you can always go to our YouTube page and see those, or if you go to ftmdaily.com/5 levels, you'll see some of the videos that we've already done on this. We can really boil it down to this. Store what you eat and eat what you store, right? Just don't go out and buy things because you think that they're going to be, perfect for that emergency. Just buy stuff that you want to eat anyway, and then eat what you buy. That's just a really simple process. And in essence, what you want to do is you want to get to the place where you have 6 months of food and water supply. What do I mean by that? If all of the stores shut down, and listen, I know that sounds crazy, but let me tell you something. Our world is so integrated. And of course, we have a globalized society. But here in the United States, I have heard over and over again how precarious our food and water supply chain really is. If one truck can't get to Walmart, trucks come into Walmart every single day. These semis are driving all over. You see them on the highways. What happens if that system breaks down? What are you going to have for food? I mean, pretty quickly, Walmart will be out of groceries. Your local grocery store will be out of groceries. So it's important for you to keep that in mind and not to become a victim later, and instead actually become a person who actually has extra that you can help other people. I think that's the whole point of having financial freedom, is that you can actually help others that have not quite made it there yet.
Yes, exactly. And that can be part of your idea from level 1 of your charitable giving plan. Is part of your extra food and water supply. You can plan to help others in a time of need as well.
That's so right. So our very first step of level 3 is to build a 6-month food reserve by stocking up on foods that you already consume that have long shelf lives. And then finally, you need to decide on how you're going to store water. You could have an in-home water storage or a portable water filter. That's what we do. We have a really nice body of water nearby. In fact, if you watch the video on our water storage, we actually have some large 55-gallon drums that we keep full of water. And there's a certain method to that we use. But also, we're very close to a nearby body of water, and we have a very nice water filter that's portable. And so in the event that our water supply was poisoned, as was the case in West Virginia just a couple of weeks ago, or if the water gets shut off for some reason, we can always run down to that body of water and turn it into drinking potable water that we can use to help our family. Now, step number 2 in level 3 has to do with our savings again. Okay, we're going to take our 2 months of liquid savings that we built up in level 1, and we're going to turn it into 6 months. Now, this is admittedly probably the hardest part of the entire 5 levels of financial freedom, I would say. So whenever I say 6 months of liquid savings, what do I mean? Well, 6 months of your gross annual income. So again, if you're earning $3,000 per month, then at all times, whether you're 6 or whether you're 65, well, not if you're 6, but if you're, you're 26 or you're 62, it's important for you to have at all times 6 months of liquid savings. How many people who became unemployed would have fared so much better had they had 6 months of liquid savings? How many foreclosures would have been prevented had people had 6 months of liquid savings? To me, it's not an option.
And Jerry, just to clarify, do you mean gross income or actual 6
gross.
months of take-home pay?
No, I mean gross. If you're earning $3,000 a month, then what we want to do, and I know this sounds daunting, if you have 0 in savings right now, that's why you got to start at level 1. But when you get to level 3, we're going to save up 6 months of our gross annual income in liquid savings. Now, there's a couple of things, a couple of reasons for this, and a couple of comments I want to make on it. First of all, there is a principle that I call the risk relation principle, and it has everything to do with you becoming a better investor, and it begins with saving. So The risk relation principle says this: the amount of risk that someone is willing to take is inversely related to the amount of liquid savings that he or she holds. So this principle explains why so many investors who have little to nothing in savings are always trying to hit a home run with virtually every investment. Because people who don't have any liquid savings, they take excessive risk, oftentimes unnecessary risk, with capital in the hopes of turning a very little amount of money into something bigger. In essence, what they want to do is they want to make up for their lack of disciplined savings through gambling with their investments. And this investing approach is usually a sure ticket to the poorhouse. So people who don't have any liquid savings make worse investors. And those who have plenty of liquid savings, like our 6 months here, make excellent investors. And let me tell you a few reasons why. Remember the crash of 2000, the dot-com bubble. There was a gentleman I knew at the time who was actually retiring. He was a good friend of mine. He was retiring, and his account was cut down to nothing. And he was very heavily over leveraged with a option. He was using options. He was using a margin. He was heavily invested in a lot of the tech stocks. And he had made a lot of gambles because he didn't have a whole lot of money. So what he did was he took the money that he had and he really went aggressive with it and lost his shirt in the dot-com bubble. Now, because he did not have any savings, all of this money was in retirement funds, as he was going to retire, he didn't have an option. He either had to stay working or he had to begin taking money out of his investments when they were at their absolute positive lows. And of course, that's the wrong time to be taking money out of your retirement accounts whenever you have a devastating dip. Unfortunately, during 2000 and also the crash of 2008, so many people didn't have savings, and so they had to dip into their retirement accounts just at that moment, whenever their stocks were down, and begin to take money out. That was devastating to so many people who had to sell at those very lows just to get cash out of their accounts. So in other words, by having a nice 6-month savings reserve at all times, it allows you to weather those kind of storms and rely upon your savings whenever the market's down really bad, and rely upon your investments when you want to pull some cash out of the market. So it's really a great way. It makes you a better investor because you don't have to worry about cashing out at a market low because the market crashes. You have your savings that you can rely on during that time.
That's right, Jerry. And also, I think maybe a second part of the way that savings makes you a better investor is, let's say that there is a really, really great opportunity to invest in a rental property in your town, and you want to really get this rental property, but you need some cash. Well, it's great because you have a 6-month savings reserve, and although we don't want to use the savings necessarily for investments, but if there's a really great opportunity and you have that liquid savings, then it helps you in that matter too. You can take advantage of a really great deal if the opportunity pops up and you have cash.
It is. That's exactly what it is, Jennifer. It's an opportunity pool of capital. It's not just your savings. You want to think about it as an opportunity pool of capital. Remember, cash is king at the crash. That's been said over and over again. So having cash puts you in a very enviable position whenever we have another market downturn. It allows you to scoop up assets that are cheap with your money. Now, this money, by the way, this 6-month liquid savings reserve needs to remain liquid. What does that mean? Well, it means that it needs to be accessible. You need to be able to tap it at any time. Now, this is pretty contrary to what Wall Street teaches. I mean, when you get a job out in the real world and you get out there, you get your college degree or you get your high school degree and you get out into the workforce, you often hear some real basic advice, and the advice goes something like this. Max out your 401k, right? Open up a traditional IRA, buy a house, because real estate always goes up in value, right? You hear all these things. And all of those things, by the way, are completely illiquid. I mean, you put money into them, and it sounds like a great idea. But what about your savings, right? You can't tap those things. If you want the money out of your house, of course you can take out a home equity line of credit, but it's that obviously costs money, and it costs money in interest is what I mean. So that's certainly illiquid. your traditional IRA is not meant to be tapped for any kind of rainy day fund purposes, as your 401k is the same way. So it's very important to build up this 6-month liquid savings. Now, let's say that you have $3,000 a month coming in every single month, and you are committed now to building up this 6-month liquid savings reserve. So it's going to mean 3,000 times 6 months. That's going to be $18,000, right? So that's $18,000. So we're going to be saving this. And once we save it, we're going to keep it at that level. We're always going to take a look at our gross income, and we're always going to have at least 6 months of that in savings. Now, many people will be quick to say, Jerry, you take that $18,000 and just throw it into the bank and call it savings. You're going to lose your shirt to inflation, because we all know that over time, the purchasing power of the dollar is losing pace. And so it's important for us to be diversified. Well, friends, I'm totally with you on this. And this is why we've created what I call our diversified 6-month liquid savings reserve.
That's right. And this is actually step 3 of level 3. And this is where we take our 6 months of our liquid savings and we now diversify it. Diversify it because, like Jerry said, inflation will literally eat away at this liquid pool of cash.
Now, I'm getting a little bit ahead of myself, but diversification really applies to 3 different areas of your financial life. Investments, right? Obviously, people say diversify your investment dollars across a wide, various set of asset classes. That's what we teach here. We also teach something unique in the fact that we teach income diversification. We're going to talk about that when we get to level 4 to level 5, creating multiple streams of income into your financial life. But also, we teach something that I think is very unique, because I've never heard this anywhere. We're the only, and I'm not saying that we're special because we came up with it, but I really haven't seen it anywhere else. And it's savings diversification. And we created a strategy called the DSL, the Diversified 6-Month Liquid Savings Reserve. And over a period of time, we back-tested this to find out how it worked. First of all, before we talk about how it performed, what does it look like? Well, what we do is we take our 6 months liquidity, okay? We figure out what our 6 months of gross annual income would be. And instead of just taking it and putting it into US dollars and stuffing it into a savings account at the bank, we instead diversify it 3 ways. Now, this is the way we approach it. Now, you may choose to approach it a different way, but this is the way we have approached it, and this is the way we've studied it, back-testing it for 20, 30 years to find out how it would perform. And in our strategy, what we do is we take 1/3 of that $18,000, that 6 months. And in our case here, we're talking about $18,000 because you're making $3,000 a month. You have 6 months, so it's $18,000 total. We take 1/3 of it and put that into US dollars, like a savings account or a money market. You got to have US dollars, right? You got to have some. We take the second third and we put it into stable foreign currencies, or a basket of stable foreign currencies.
That's right. And, with this part of our diversification, we have many, many people asking, well, what is a stable foreign currency? What does that mean? Well, we have a very nice service that can answer those questions, and it's part of our FTM Insider membership, and it's a brand new service called the Global Currency Monitor, and it talks about 9 different foreign currencies, and it rates them every single month. And so that's one nice service that we offer to our FTM Insiders that helps with this part of the savings diversification.
Yeah, and you can diversify using ETFs. I mean, there's practically an ETF for every single major foreign currency that's out there. Or you can actually buy the physical foreign currency itself and hold it. You can buy those at Bank of America. You can buy them at your local bank. They're not hard to find. And so that's what you can do. We prefer to use ETFs because, foreign currencies are just paper. It's not like gold and silver where you want to have possession of it. It doesn't really matter with foreign currencies. It's just paper assets, right? So it's okay to hold it in the form of an ETF. That's the way I prefer it. It's cheaper that way. You don't have to pay as many fees and exchange rates and all this whenever you use the ETF. So the first third goes into US dollars. The second third goes into foreign currencies. And then what's the third go into? Precious metals, gold and silver. Now, we back-tested this over a period of 20 years, and we compared it to taking our money and just throwing it into 3-month T-bills. And what we found was simply astonishing. We could not believe what we found. When we compared it from a perspective of just putting it into 3-month T-bills versus putting it into this diversified 6-month liquid savings reserve using these 3 different asset classes, we found out that the total percentage return on our savings from 1992 all the way out to the end of 2011, that's the latest study that we've done on it, returned 201%. Can you imagine on your savings? That's outrageous, isn't it? From 2002 to 2011, that was a 10-year period, it returned 205%. And then from 2007 to 2011, a 5-year period, it returned 54%. The reason is that we were diversified and not just in the U.S. dollar. This is an indictment, I think, upon the U.S. dollar, showing you how much purchasing power we're losing every single year to simple inflation. Now, it's hard to see. You don't really see it, but you leave the country, and all of a sudden you begin to notice it. So our DSL, our 6-month liquid savings reserve that is diversified, is a powerful tool for you. And I think it makes saving the money even more exciting because you get to diversify. It's not just going to be thrown to the bank into U.S. dollars, but you'll actually be able to diversify it, and you'll get your first taste of buying gold and silver. That's actually an investment, isn't it? But in many ways, we view gold and silver as insurance. Again, it's almost like protection. What is it protection from? It's protection from an out-of-control Federal Reserve. It's protection from an out-of-control U.S. government. Gold and silver provide that insurance.
Well, and Jerry, also for the majority, all except for the last couple hundred years, gold and silver have been money in the world. It's been the money that mankind has used. And so, to not view it as money now is contrary to all of human history. That's
so right. I mean, gold and silver are money. I mean, that's just what they are. And so actually holding some of that, having some of that in your savings is absolutely vital in our opinion. So that's certainly a major component of level 3. And that's really the 3 parts. We have our first part of 6 months of food and water. Second part is to build up that 6 months of liquid savings from the 2 months that we had created in level 1. And then finally to diversify it, like we just talked about just now. We recommend, and I say we recommend because we don't really recommend anything, because everybody has their own needs and has their own circumstances and all this. But we, as a whole, find that diversifying with these 3 different areas seems to be a very powerful way to stave off any kind of loss of purchasing power. Well, there's so much more we could say here. I mean, there's so much more. We've written extensively on this. If you want to read about our diversified 6-month liquid savings program, you can. It's completely free on our website. It's just ftmdaily.com/DSL, like D as in diversified, S as in 6, and L as in liquid. DSL. Just go there, read about it. You can see what we do, and hopefully it'll provide you some really good insights on your savings. Now, remember, the other thing that perhaps I didn't emphasize so much in level 3, and you can read all this as you read through this on our 5 levels on our website, is that in addition to all of this, we really want you to begin to save that 15% that we had talked about in level 1. We want your profit rate to be a minimum of 15%. And by doing that, you'll be setting yourself up to invest. So this is what we do. We take our 15% of our monthly gross income and we're saving it until we finally get to a place where we have 6 months of liquid savings. Then we take that 15% that we're saving and we divert it over to our new investing pool. And that's what we're going to talk about next week. We're going to talk about how to begin investing once we have our savings. And I tell you what, so many Americans put the cart before the horse. They try to get invested. They try to get all these things going. And it really is the tortoise that wins the race here. There are so many rabbits, so many hares out there running down the road, going 90 miles an hour, and they crash and burn. And this system that we're showing you, these 5 levels of financial freedom, it's going to take discipline. There's no doubt about it. But we're right here to help you. We're always one phone call away. You can always call us and get help. And we're here to help you because we believe that this particular process, we know it's worked because it's worked for us. And so we want it to work for you as well. And so that 15% that you're saving every single month, you pour it into your savings bucket. And once that thing is full to 6 months of liquid savings, you then divert it and start filling up an investment pool. And that investment pool is going to be diversified. And we're going to talk about that next week. We're going to talk about investing. Finally, I know many people have said, yeah, finally, no more insurance, no more. Well, you know what? This boring stuff that we've been talking about up to this point is very, very fundamental. It's very vital. And if you get this right, then the investing part is going to be that much more fun for you and much more productive.
Who can you trust nowadays with your money? A Christian financial advisor may be the answer. Visit our website for more details at www.cfanetwork.org. Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
I want to streamline this today and get right to the three things that are on my mind from watching these markets for 35 plus years. I really boil it down to three things that I'm going to watch very, very carefully throughout the year, and you should too. The first is we saw on Friday the Deutsche Bank quit being a price fixer for gold after over 100-something years in the famous Rothschild room that's used in London, where twice a day the price of gold is fixed after all transactions are looked at. The Deutsche Bank has been one of the longest price fixers of gold, and abruptly on Friday they announced that they were not going to be a part of it anymore, and a lot can be read into that, from conspiracy to wanting to get out before things get real bad until investigations get into price fixing further. We've already seen the LIBOR investigation break in England on the interest rate fixing that has cost J.P. Morgan and other firms billions of dollars in fines. And now this price fixing on gold manipulation also could start. We've been talking about it for a couple of years in detail, but we're now starting to see major players pull out. So you've got to watch this closely to see if any other major players pull out of the price, the gold fix that occurs twice a day in the Rothschild room in London. Number two, and to me, by far the most important, we have sent out on Wednesday, the 22nd, an email that hopefully all y'all got from Richard Russell talking about the dollar is the one thing to watch, as it pretty much controls that and interest rates as to what the next move is going to be. We've been very fortunate so far in this country, even though our fiat currency debt is going above $17 trillion, and now the Senate and Congress has upped it to where it can go to $18.3 trillion, and probably will do so, in less than a year. And this time, without any debate or anything, they just passed it. But the dollar looms out there, and we've said many times, and once it breaks back down to 78 from the 81 that it is right now in the world market, that's pretty much when we think the game is over, and that's when gold accelerates above the 2,000 number and goes on up to much, much higher numbers than that. But Richard, who's the Dean of Writers of Newsletters for over 60 years, World War II veteran, continues to give us incredible information on the dollar and what's going on worldwide. The difference in the rest of the world and us, we're not dealing with our problems. We're just printing money at astronomical rates. But we are seeing the Abenomics, as they're calling it over in Japan, where the head of Japan's doing the same type thing we are here, just printing a tremendous amount of currency out of thin air. But this will be the year, 2014, when the dollar breaks below 78 in our opinion, and when it does, it's going to be off to the races and could go all the way back to 72, about a 10% drop, and if that happens, gold will go up about 13% for every 1% the dollar goes down. That's what has happened over the last 13 years. And then lastly, for the ones that are following the metals on an industrial demand issue where people are saying gold is going up and continues to widen the spread between gold and silver, where we now see the ratio at over 62 to 1, with gold being over 62 times more expensive than silver. But James Turk came out last week, the most prominent so far, and we're starting to see more and more saying this indicator has to be watched extremely closely, because if it goes back toward 55 and then back toward 50, where silver is going up faster than gold, that's when we're going to see the inflation finally kick in to where we're going to see people moving to silver for industrial demand, electronic demand, and they're going to start buying silver to store for industrial use once they feel the world is out of the woods for a major contraction, meaning a deep recession or a possible depression. So this ratio right now continues to see gold keep going to higher and higher numbers, which leads people to believe that they believe gold will be currency, and the Chinese certainly are capable of doing that based on the gold reserves they're currently buying. So these three things have to be watched really with a fine hourglass. I mean, this thing is could break any day. And like I said, the Deutsche Bank, in quick review, the Deutsche Bank could have other people that are in the room when the gold fix comes twice a day in London. If other people walk out of it, it's going to really be smelling a rat, and it probably would mean to get into gold and silver as quick as you could. The dollar value, as it goes towards 78 and interest rates rise, and we get a rotation of money back out of stocks and bonds and back into gold, which will happen if those two events happen. And lastly, watch closely the spread between gold and silver until the major industrial users are convinced we're out of the woods for a recession-depression. That ratio could stay above 60, but if it starts going down, you want to get in silver as fast as you possibly can. And as we've talked about the last several weeks, I'm not going to keep talking about it, but you need to get into palladium if you don't own any as quickly as you possibly can. If any of you need to talk to me, you can reach me at 800-247-2812. That's 800-247-2812. And if you have IRA money you want to put into a self-directed precious metals IRA, we can discuss that and how you can download the application and the rollover form to make that happen. So hopefully we've covered a lot of information today, and if you do need me, you can reach me. And lastly, if you're not on our email blast, you can sign up for that at FTMDaily.com and hit the precious metals button, and you can sign up, and we'll send you 2 or 3 email blasts a week to keep you abreast of what's going on in our world of precious metals. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
With this week's Trigger Trade Report, I'm Jennifer Robinson. Well, this week was an interesting week in the stock markets, as Thursday and Friday were major losers in U.S. stocks. Now, our trigger trading portfolio actually performed quite well, as we were only stopped out of one stock, which was ticker symbol CW, with a 3.99% loss. We sold 3 positions this week to lock in some gains, including ticker symbol HAR for a 4.99% profit, ticker symbol GDX for 3.5% gain, and ticker symbol CI, which was up 1.63%. Currently, we have 1 stock in play and are awaiting Jerry's trigger price on 7 other stocks. Trigger trading is a service we offer to all of our FTM insiders, in which they receive a stock trading idea every single day of the week, complete with Jerry Robinson's trigger price, stop-loss price, commentaries, and daily status updates. You can learn more and view all of our past trading results at FTMDaily.com/trigger trade. That's FTMDaily.com/trigger trade. The following is an excerpt from Jerry Robinson's best-selling book, Bankruptcy of Our Nation.
There's an old joke about money that goes something like this. Money may not buy happiness, but it sure does buy everything else. Benjamin Franklin referred to man's obsession with money this way. He that is of the opinion money will do everything may well be suspected of doing everything for money. Regardless of our own view of money, one thing is certain. Money is a necessity for life in this world. Before attempting to answer the essential question of what money really is, let's first consider how the American culture and our own upbringing has affected our view of money. From my own research, I have discovered that an individual's view of money is determined by at least three fundamental factors. The first and perhaps most influential factor that affects a person's view or conception of money is the economic system into which the person is born. For example, a person born and raised in the United States is introduced to a capitalistic economic system from birth. The virtues espoused under capitalism include the right to private property, the division of labor, and individual rights. In contrast, those who are born in China are taught to view money through the lens of a communistic economic system. Under communism, individuals have fewer rights, and the government plays a much greater role in every aspect of life. The second factor that shapes a person's view of money is the financial philosophy espoused by his family. Whether or not we realize it, parents are teaching their children by their words, and more importantly by their actions, about what is important in life. For example, a mother who spends excessive amounts of money teaches a different set of financial values to her children than a mother who is an avid saver or an astute investor. The spendthrift mother is silently teaching her children that overconsumption is a desirable and perhaps even a virtuous act. Meanwhile, the mother who gains joy from saving and investing is teaching her children that preserving and growing money is far more important than spending it. To use another example, a father who exemplifies a strong work ethic to his children is teaching them that money is best earned through hard labor. In contrast, a father who runs his own successful business is silently teaching his children that money is best earned through a combination of personal hard work and by employing the efforts of others. Finally, some families treat the topic of money as taboo and rarely discuss it around their children. Inevitably, these families are teaching their children that silence about financial matters is preferable to openly discussing the topic. The third factor that ultimately determines a person's view of money is rooted in their religious and moral understanding of life itself. For example, it is common for a person who has had a strict religious upbringing to view money as inherently evil. Now, personally, I believe money to be completely amoral. Money is not capable of being moral or immoral. It's merely an object. Instead, money can be used for good purposes or bad purposes. Those who are searching for the morality of money do well to consider the intentions of its possessor, not the money itself. To summarize, everyone's view of money has been shaped by a combination of the three factors stated above. Why is understanding this important? Because our particular view of money greatly influences our own financial decisions. The fact that you are holding this book in your hands is proof that you have a desire to improve your own understanding of money. It's also likely that you are deeply concerned about America's uncertain economy and how you can protect your family and yourself. If so, then this book is exactly what you have been looking for.
You have been listening to an excerpt of Jerry Robinson's best-selling book, Bankruptcy of Our Nation. To order your copy in either paperback or audiobook, visit ftmdaily.com/bankruptcy. That's ftmdaily.com/bankruptcy.
Jay Peroni, certified financial planner, here with the idea of the week. This week we'll take a look at an airline stock that's ready for takeoff in 2014. Many investors have overlooked the travel industry and are missing out on some nice gains. Airline stocks have had a good run recently, and I expect that trend to continue. In case you haven't noticed, airline stocks have been red hot. With the economy improving, consumer sentiment rising, and an increase in leisurely spending, the travel industry has seen a boost. The travel forecast for the next several years looks pretty bright as well. As the economy continues to recover and consumers have more money to spend, the travel industry, especially the airlines, should continue to see impressive growth. I recently added an airline stock to my Tomorrow's Treasures portfolio, which seeks out small cap stocks. The company recently raised its fourth quarter earnings guidance, easily trumping analyst expectations. Better yet, I expect it to post double-digit earnings growth in 2014 as well. The reason I like this airline over its competitors is the fact that it's a small company with lots of growth potential. It caters to low-cost travelers and offers a $9 fare club that is just $59.95 per year and on average saves its customers $75 per booking. The program provides access to reduced fares as well as other travel deals. The company I'm referring to is Spirit Airlines, ticker symbol SAVE, SAVE. Spirit operates approximately 250 flights to 50 travel destinations in the United States, the Caribbean, and Latin America. It is also one of the few airlines that travels from the United States to Panama and Colombia, two travel destinations that are becoming more popular. The stock had an impressive run in 2013, and I believe it's just getting started. Its next earnings report is in February, and Spirit has a stellar record of positive surprises. Since it went IPO in 2011, it hasn't missed earnings yet. Even though its share price has soared, its valuation is still very reasonable. It has a forward PE of just 16.4 compared to an industry average of 22.5. With its impressive earnings growth and relatively low PE, the stock presents both a good value and great growth potential. It scores positive in financial strength, valuation, momentum, and earnings trend. It scores a neutral in risk. It is a little more risky because it is a smaller company. The bottom line, Spirit Airlines, ticker symbol SAVE, is a good buy up to $55 per share. My 12-month price target is $65 to $70, representing a 30 to 40% potential gain from its current prices. Again, that's Spirit Airlines, ticker symbol SAVE, worth a closer look. If you need help with your investments, you can give me a call and have a free 30-minute portfolio review. Give me a call at 866-594-9919. Again, that number is 866-594-9919 for a free 30-minute portfolio review. This is Jay Peroni, Certified Financial Planner, signing off for the Idea of the Week. We'll see you again next week.
Well, friends, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It's an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time spoken by the famous philosopher Socrates, when he said, "An unexamined life is not worth living." Just something to think about. All of our FTM insiders, you should know that our brand new newsletter is now available online, and it is also going to be en route to your home if you've ordered the print edition. It should be arriving in the next several days. Everyone have a wonderful and safe and prosperous week, and I'll see you right back here next weekend. God bless.
All of the information contained on Follow the Money Weekly Radio is strictly for informational and educational purposes. The views and opinions of all guests, including our sponsors Tom Cloud and Jay Peroni, are their own and do not necessarily represent the views of Jerry Robinson, FTMDaily.com, and or Robinson Media Group, LLC. Jerry and Jennifer Robinson do hold their insurance licenses and may offer consulting on life insurance and fixed retirement income products. Remember, never do your financial planning through podcast or by radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.